Delta Airlines, one of the oldest and largest airline companies in the world, just reported Q4 earnings earlier this week, and the stock actually declined about 3% after initially dropping about 6% off the backs of a poor airline environment where many airlines are still recouping losses from the lockdowns. This now takes us to a market cap of about 24.5 billion, a PE of 335, and a slashed dividend, which really sums up the industry as a whole right now, but we'll discuss more about that in just a little bit. But as value investors, we have to ask ourselves if now that we have seen such a massive decline in this sector as a whole, whether or not there are any buying opportunities in oversold markets like some of these airline stocks are now that it is down about 38% or so from the 2020 highs, or if we should divert our attention elsewhere. Well, make sure to stick around as we'll answer all those questions and more on today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. We will be starting this video off by analyzing the key fundamental data behind this business, what's driving this business forward, and we'll be discussing where this business will be headed in the future. Finally, we'll conclude with an analysis using our intrinsic value calculator, which will identify the buying opportunities with this stock. And if you do enjoy this type of video, make sure to like the video and subscribe as we post on here regularly analyzing the businesses that you are most interested in. So make sure to comment your video recommendations in the comment box below. With all that out of the way, let's jump into the analysis. All right, Delta Airlines' Q4 2022 earning results. What have they reported on? Well, we immediately are presented with the fact that they are still navigating a strong demand environment that they say is still continuing with revenue recovery here from 2021 of 50% all the way up to now in this quarter with over 100% revenue recovery versus their 2019 levels, because as you know, we had a lot of lockdowns. Airlines were shut down. No one was traveling, so it was a huge hit to the airline sector. And Delta seems to be leading the way with that revenue recovery now exceeding those 2019 levels. And we can see how that has been progressing over the last few quarters. We have to wait and see if this is a trend that will continue or if it's going to start to taper off, especially with, high levels of inflation. A lot of consumer spending has tapered off with a looming recession at hand. So it's something we have to keep watch on over the next few quarters, that's for sure. But they're saying for the next quarter, at least they have strong first quarter 2023 bookings already. So keep an eye on that. When we look at this chart here from Main Street Financial Data, first link in the description. So make sure to check out our video sponsor because they're helping us investors break down and analyze key investing data in order to make informed investing decisions. And so from this chart alone, we're able to see the passenger miles that Delta has reported on over the last few quarters. And as you can see, we had a significant decline back in 2020, but now since then we have seen that revenue recovery, which is in a direct correlation with these passenger miles that have been increased. We want to see this continue to increase and exceed those pre-2020 levels to really establish that further growth in this business. And that's something we have just not seen as of yet. Conversely, if we look at this chart here, which is the revenue by segment, while they have been increasing those passenger miles, they've actually been able to exceed, like they mentioned earlier, those 2019 levels of revenues as they've really built up their cargo and other section of their business, which is what investors are looking for at this point. To see a revenue recovery during this period of time is definitely a good sign for potential investors. And how exactly were they able to achieve this despite passenger miles not exceeding those 2019 levels? Well, we look at this chart here, it's because of their premium seat growth, which has outpaced their main cabin sales, okay? And it's because of their premium seats having strong margins here that they can really recognize revenue at a higher rate, which is ultimately increasing and improving this business as a whole. They also have partnerships with Sky Miles, which is bringing in some more cash to the business. So, decent things going for them. And they're really trying to make that transition over to, a more premium customer experience. Okay, when we break this down from a fundamental level, this quarter, they were able to bring in $1.5 billion in operating income. That is higher than this period in 2019, at least from a GAAP perspective. However, if we look at this from a full year's perspective, 3.6 billion versus fiscal year 2019, they had 6.6 billion at this time. So we're still not there, at least from an operating income perspective, because of the high costs that they do have. We've seen that hit to their margins as well. So we really want to see how this can improve over the next few years and the next few quarters. We can see here they've had higher fuel expenses, higher cost per seat mile, etc. Okay. The other thing we need to be aware of is the debt that they currently have on this balance sheet, $22 billion in debt versus the $10.5 billion in debt that they had at this time in 2019. When we look at this from a balance sheet perspective, debt should be a concern for investors at this point. We've seen how this has really really ticked higher over the last few years and the last few quarters, taking a severe hit to their equity within the business. So keep this in mind for the end of the video when we get to our calculation. And also make sure to understand the multi-year industry constraints that Delta Airlines does expect going forward, with the aviation supply chain delays, pilot constraints, rising costs of capital, limits on industry infrastructure, etc. And as long as we're still in that inflationary environment, we're going to see higher fuel and labor costs. So definitely not a strong outlook for this business going forward. But as you know, the best time to buy a business is always when it's in that downturn, because once it does start to improve on some of these struggling metrics, imagine we see less input costs, things like that, at that point we'll see this business and the stock price definitely tick higher. But it's really understanding if this business can achieve that going forward. And I mean, as long as they can stick to the industry long-term trend here, where air travel revenue is typically in and around that 1.4% of GDP, that means that we should still see some form of rebound going forward to get back into that long-term historical range. So also make sure to keep something like this in mind when you're making an investment decision. Finally, let's take a look at their cash flows here. For this quarter, at least, they had about $1.2 billion in cash from operating the business. But once we look at the capital spending here, high levels of capital spending wiped all of that out on maintaining and sustaining the business. And so they don't have anything left over to actually reward shareholders with, other than, using debt to pay off some more debt. Okay. We also make mention here, the dividend has been cut. They used to pay a dividend if we compare this back to the 2019 levels. So, it's another reason why this stock has declined, and the airline sector as a whole. But if they can deliver on their long-term commercial strategy, to expand their premium revenue segments, grow that loyalty ecosystems, again, using that Sky Miles, things like that, increase revenue diversification, it's possible that we should see a rebound in this stock. For 2023, at least, they're looking for 15 to 20% revenue growth, which is huge for airline companies. They typically grow in and around that 5% range on a year-over-year basis. They're looking to improve their operating margin as well, and come in with about $2 billion or so in free cash flows. Their leverage is still pretty high, with over 3x right now and expected for 2023. But as of 2024, not only should free cash flows grow, but also leverage should come in. They're going to look to pay down a lot of that debt using those free cash flows over the next year or so. Something to keep mind of. So if we take all this information into consideration and apply it to our calculator here, if we look at their historical results, they have been able to produce about $6 billion in operating income in the best case scenario. But if we expect that over the next few years, they can produce about, let's just call it $3.5 billion in operating income. And if we require a 10% return, and we expect that the dividend will still stay cut for the time being, at least, if they can grow at 5% for the first 5 years, that drops off to about 3% on a 30 PE like they were historically trading at. Unlike where they are right now at 335, I mean, this could be a business worth about $99 per share if they can really grow the earnings from operating the business. But that being said, we do have to deduct a few points here when it comes to this intrinsic value calculation, simply because of the high levels of debt that they do have on the balance sheet, and because of the high levels of competition that they do have in this space. There's a wide variety of airlines that you can choose from whenever you do want to travel. So we're going to change this number to about $60 per share in a normal case scenario, with the rebound in the economy and 15 to 20% growth on their revenues over the next few years or so, which I think is a lot more realistic here for a business like Delta, especially with industry constraints that they have as well. But in the very best case scenario, where they're able to achieve all the growth metrics that they set out to, and they're able to really capitalize on their premium transition, along with a rebound in the economy as a whole, we see 8% growth for the first 5 years, 5% after that on a 35 PE. The stock could actually be worth about $144. So if we make an adjustment here to account for the debt that they have and the competition and the environment that we're in, sort of thing, in the best case scenario, we could actually be sitting at about $100 per share. Still some significant upside from where we are currently, but we always have to look at this in the worst case scenario. So if they're only able to grow for the next 5 years at just 3%, they come in shy of what they were expecting. And for the 5 years after that, only 1% on a 15 PE, where there's higher competition, we see more inflationary cost pressures that eat up those revenues, then we can expect this business would be worth about $41 per share. But when we adjust for the debt that they also have on the balance sheet, and if we expect higher levels of competition, then the business would only be worth about $26 per share in the very worst case scenario here, which means we would have a little bit of downside here, at least from where we currently are in the stock price. That being said, if the airline sector as a whole actually made improvements, again, that rebound in the economy definitely helps out, where consumers begin to spend more, things like that. they're actually able to reinstate the dividend. You can see how this changes our growth metrics here. So I hope that helps you understand a little bit more about the risks and reward with this stock, with investing in an airline company like Delta Airlines. You know, we were up in that $60 price range just before 2020. So it's definitely somewhere that they can get back to, especially with the rebound in the economy. And if they can achieve those growth opportunities that they set out to, I mean, yeah, we can definitely see an increase in the stock price from these levels. But if the converse is true, they're not able to achieve those targets that they mentioned, you know, we see further cost pressures on fuel, on some of their other input costs. This business will probably continue lower into that $26 per share price range like we were at, you know, at the start of 2020. And that's where you really have to make an informed investing decision on where you think the stock will go. They did cut their dividend as well, which is a big part of why the stock was up in that $60 per share price range. So again, a lot of things to consider. Let me know what your thoughts are on this business in the comment section below. Do you think they will get back up to $60 per share or higher? Or will the earnings suffer more, leading to lower stock price levels? Let me know your thoughts. If you've enjoyed this video to this point, make sure to like and subscribe. It really helps out the channel. Check out our video sponsor, Main Street Financial Data. Again, first link in the description. And with all that, I'll catch you on the next one.